China's headed straight into recession. Their exports have fallen to the lowest numbers we've seen in years. This has crushed all hopes for their economy recovering post-COVID lockdowns. Let's find out more. Grim reality. China's latest economic stats are out, and let's just say it's not looking good for Beijing. We're talking about below average growth and plummeting retail sales. These two warning signs are signaling their downfall. The nation's hopes for a post-COVID economic recovery have been destroyed, to say the least. You see, China's GDP fell way short of the 7.3 estimate predicted by Reuters' poll of economists. And to make things worse, retail sales took a nosedive from 12.7% in May to 3.1% in June. It makes sense because inflation increased by 0.7% throughout the first 6 months of 2023. Let's not forget, more and more people became jobless. Unemployment increased across the country, with 21% of those aged between 16 to 24 out of a job. It's like wherever you look, there's a haunting statistic to prove China's economic slowdown. Could they be heading towards a recession? Highly likely if you ask us. What's more, disappointing trade data revealed that imports fell 2.6%. Meanwhile, exports, a major driver of China's economy, fell 8.3% year over year in June 2023. Flashback to the end of 2022, Beijing eased its strict zero-COVID lockdowns. People were hoping for the world's second largest economy to rebound. Well, the country's post-pandemic economy hasn't flourished, as expected, so that rebound doesn't seem to be happening anytime soon. Seems like the country is unable to come out of a post-pandemic hangover. Now, China's 2023 seems like a year they'll never forget, no matter how they want to. Recently, the CSI 300 and Shanghai Composite Stock Market indices also fell under 1%. This would or show that investors are fearful of the most recent data that's come out of the country. Things are so bad that the ruling Politburo of China is scheduled to meet soon. Economists expect that a stimulus package to revive their dying economy. The People's Bank of China has already lowered key borrowing rates. This is an effort to make people spend more, but authorities might have to take more extreme action than this. Is the growth era over for them? In all honesty, even the most optimistic recovery forecast for China seems gloomy. Experts don't see China returning to the explosive growth rates it's become used to for decades. Since Beijing's economic reforms in 1978, China's GDP increased by an annual average of 10%. But since the pandemic first started, China has experienced many ups and downs. Private sector crackdowns and zero-COVID lockdowns have wreaked havoc on supply chains. This has destroyed all investor confidence to pump money into the country. More bad news arrived in 2023 as well. For the first time in 60 years, the country's population fell. This raised doubts about the viability of its labor force. Can China ever hope to return to that level of high growth? Especially now that President Xi Jinping has cemented his position as the country's leader for the near future? The short answer is no. Economists and analysts believe that China's period of double-digit growth has definitely ended. How will Beijing respond to China's economic issues? The answer will determine China's economic growth in the next few years. And by the way, this is going to become a global issue. Even if it's not equal, the truth is that the slump of China's growth will affect us all. Many countries will feel the drop in demand, especially those who have come to rely on China as their main export market. Who will win and who will lose during this shift? That depends on how fast they can switch to other faster-growing emerging markets. For example, those in Southeast Asia and India. The slowdown will also impact the geopolitical power balance, and analysts predict unrest in China as well. It's true the global economy will be at risk from their economic downturn, but it won't be as bad as China's situation. Even now, consumers are saving their money, and investors are hesitant to invest in Chinese businesses. In contrast to 2022, private investment has almost come to a standstill this year. And guess what? China already has a housing shortage. But on top of that, developers are forced to take on more debt to pay off previous ones and finish ongoing projects. And that's not even their biggest problem right now: dwindling exports. Now let's talk about the sharp fall in China's exports. For a country known as the world's factory, that can't be good news, eh? After all, a country's export sector supports jobs and helps in strengthening the economy. But it's uncertain as to what extent China will be able to rely on its exports, especially now that its largest trading partners are in business with other Asian countries. For instance, the Trump administration increased taxes on Chinese industrial items in the US. This makes it more expensive for American businesses to buy from China. Then, President Biden persuaded Congress to approve large incentives for American production, particularly in industries like solar panels and electric cars last year. As a result, exports from China to the United States decreased 18.2% from May 2022. In fact, they've decreased at their fastest rate since the COVID-19 pandemic began. There's pressures on Chinese officials to add new stimulus packages, and that's because of how badly their economic slowdown is affecting the citizens. Right now, the pace of China's post-COVID recovery has slowed. Now, economists are revising their predictions for the rest of the year. As mentioned earlier, China's shipments fell to 12.4% year-on-year in June, and this was after falling by 7.5% in May. That's a huge hit, you guys. Plus, imports fell 6.8%, more than the predicted 4% loss and the 4.5% drop from the previous month, now that diplomatic tensions over chip technology and other concerns increased. This means that exports to the United States have decreased the most over the first half of the year. But wait, in contrast, exports to Russia have increased a lot more. What's that about, you ask? We'll get to that in a... But for now, it seems like China's hopes for a speedy recovery have already been destroyed. Exports make up roughly 1/5 of the economy, and the ailing real estate industry makes up approximately 1/3. Oh, and after failing to meet their goals, they've now set a low GDP growth target of about 5% for this year. By the way, to make things worse, after the data was revealed, the Chinese yuan lost ground versus the dollar. But analysts are hoping that more drops wouldn't happen. Global markets are waiting on the next Politburo meeting stimulus measures. New partnerships? Can China's economy recover without a huge stimulus package in the coming months? Their factories were already seeing lesser output. This was owing to consumer prices inching closer to deflation in June. In fact, producer prices dropped at their fastest rate in more than 7 years. Also, there were signs of a drop in the demand for raw materials, with copper imports falling 16.4% in June from a year earlier. Now let's talk numbers. Customs data revealed that Chinese imports fell 6.8% to $214.7 billion. The amount of products exported to the United States fell by 23.7% from a year earlier to $42.7 billion. This was a 6-month low, while the amount of goods imported from the United States fell by 4.1% to $14 billion. Plus, the unstable trade surplus between China and the US decreased by a staggering 30.6% to $28.7 billion. But Russian imports increased by 15.7% to $11.3 billion. You see, to enjoy huge price cuts, China has amped up its purchases of Russian oil and gas. Now, you already know what happened as payback for Moscow's invasion of Ukraine. The United States, Europe, and Japan cut off most dealings with Russia, but China remains their loyal friend and has helped stabilize the Kremlin's financial flow. Beijing is also able to buy Russian gas and oil without provoking Western sanctions. In fact, the largest export market for Russia is now China. China is also a huge supplier of manufactured goods. So it's no surprise that exports to China increased 90.9% in June 2023, reaching a staggering $9.5 billion. Now, some experts worry that China is on the verge of a sneaky recession, one that will damage its economic growth for years to come. Economists weigh in. Analysts are calling China's situation a ticking time bomb. A recession seems to be on the cards because of a $23 trillion local debt, rising unemployment, and dwindling exports. Don't take it from us though, we've got experts weighing in their predictions too. People in China are no longer borrowing money, and the country is suffering a balance sheet recession. That is what Richard Koo of the Japanese Nomura Research Institute says. In case you're wondering, here's what a balance sheet recession, according to Koo, is. It's a time when people and corporations choose debt repayment over spending and investing their money. He'd know because he's seen the Great Recession in Japan. This recession started in 1990 and marked the beginning of the country's lost decades. Basically, economic growth can come to almost a standstill when two things happen. First, a balance sheet recession. Second, when businesses switch their goal from gaining profit to losing debt instead. In fact, China is not the first country to face a recession of this nature. This happened to Japan in the 1990s, which was a decade of poor economic growth, following up to its sluggish recovery from the global financial crisis of 2008. Need more proof? Hear this. The country's national borrowing has dropped to its lowest level since 2010. Also, the US Federal Reserve and many central banks across the world are hiking interest rates. This is to combat inflation, but China has been moving in the other direction. That can't be good news at all. Let us know what you think about China's economic slowdown in the comments below, and make sure to subscribe for more. We'll see you in the next video.